So we have our trust, and we have a set of accounts for the trust where we have revenue. So it's got a business and it's generated a capital gain on the disposal of some asset. Purchases and some indirect costs. The balance sheet is composed of the bank balance, the settled sum. Most trusts or trusts generally will always have a settled sum, which sits in the equity, and then the value of the net asset is really, other than the settled sum, is a liability owed to the respective beneficiaries. So we've got Anna and John Doe, and that ties in with Anna and John Doe here in the relationships. So let's save off on this. Actually, before I do that, I'll just show you that if we take out the capital gains, we've got ourselves a small net loss from the business. So let's now import that set of accounts. Capital gain, revenue. Of course, in this case, it has a net profit because of the capital gain. Our balance sheet balances, the net assets equals the equity. Our classification has been carried out, so bank is classified, the beneficiaries are classified as current liabilities beneficiary, so those are the loans to the beneficiaries. We've got trading revenue and the capital gain, noting where the capital gain is classified to, and the expenses. So now we can go to work on that form. So I've already started the form and filled in the front cover details. Now you'll see that we've got the total income from business, which as you saw was a loss. We've got the 59,800, which is the income of the trust estate, which is the net profit. We don't have any interest, we don't have any dividends, so we could just remove those, we don't need those. And if we have a look through here, we have that net loss, so total income loss from the business, and we need to add in now the capital gain. So yes, we had a capital gain event, and we'll fill this manually. And now you'll see the 59,800 needs to be split amongst the beneficiaries. From a reconciliation standpoint, the system does the following. It adds in the taxable capital gain, which is per the schedule. So this is the taxable gain added in here, and it extracts out or removes, reduces the income by the accounting gain, which came in through the Excel. Needless to say, we've still got the 59,800 to split out amongst the beneficiaries. So our business section is all auto-filled, noting that it's picking up whatever related to the business. There's no depreciation, and we've got to split out the... Now this is where we need to split out. So we could go 50-50. Make sure you add in the codes. So these are Intervivos resident beneficiary, presently entitled, right? So in this case, we're working with a percentage. If the percentage doesn't hold, as in it doesn't appear to have picked up the percentage correctly, we can manually intervene. So we know that there's 30,000 to split out for each of these beneficiaries, and there was 100 loss on non-primary for each of those beneficiaries. So the gross capital gain, there's no discount, there's no losses, there's no small CGT concession, so there's just a net capital gain. We can have a look at in a moment if there is discounts to apply. Okay, so that's our 30 manually handled. Let's do this one manually as well. So 30,000, and the non-primary minus 100. So it does look like we've got a trust estate. Sorry, this is the trust estate here, which, yes, maybe that was okay. Maybe the auto percentage distribution was accurate, because we have 59,800, which is 29,900. So let's just correct that. That's the trust estate income, which we're doing there, not the capital gain. Now this is all correctly split, and you can see that because there's nothing available. There's nothing available to split. Now we might be able to complete that form. So the completion process will tell us if there's any errors remaining. Okay, so this form has no errors, and that's essentially how you split out. Okay, so we have a warning here, but at least all of the errors have worked or have been cleared out, and that is essentially the way that you resolve what is a business loss associated with where you've got a capital gain. So we've got a capital gain and a business loss together. There is a distributable amount, but of course that's how you can see it breaks out at the end of the day.